Hey veterans, my name is Steve Doherty. I'm the Raleigh VA loan guy. I'm a loan officer here in Raleigh, North Carolina, and a United States Marine Corps veteran. Today I want to talk to you about the difference between locking and floating. Locking an interest rate, compelling a bank to give you a certain interest rate, versus floating, going up and down with the market to see where it's going to land. Today I want to talk to you about everything you need to know about both scenarios, whether or not you're refinancing a mortgage, purchasing a new home, getting new construction, everything you need to know. Let's take a look. But before we dive in, again, my name is Steve Doherty. I'm a loan officer in Raleigh, North Carolina. I am licensed to do mortgages in South Carolina, North Carolina, and Virginia. If you would like me to get you pre-approved or talk to you about a strategy in terms of locking an interest rate, I will leave my contact information in the video description and in a pinned comment below. I look forward to hearing from you. Okay, so first, what exactly is locking? Locking an interest rate is you obligating the mortgage bank to give you a specific interest rate on the mortgage after closing. This interest rate cannot change once they've disclosed it to you on a locked loan estimate unless your credit score changes, maybe your down payment changes, or maybe a few other scenarios that could impact the parameters of the interest rate that you've been given. On a VA loan, there's not much that can change that interest rate aside from a change in your credit score or maybe a need to switch from an automatic underwriting approval to a manual underwriting downgrade. Locks are also broken down into different time periods. The most common lock periods are 15, 30, 45, 60, and 90-day locks. What does that mean? On a 30-day lock, that means that the rate that you've locked will be given to you as long as you close within 30 days of the date of locking. And the bank cannot charge you any additional fees to get that interest rate. Now, generally speaking, the longer the lock period, the worse the interest rate. It doesn't definitely mean that if you choose a 45-day lock over a 30-day lock, that there will be a higher interest rate. But generally speaking, that's how it works. The longer the lock period, the more risk or exposure to the bank, the higher the interest rate, right? Or maybe the worse the price, meaning for the same interest rate, you're going to have to pay a little bit in points in order to obligate the mortgage bank to keep that interest rate reserved for you for that period of time. Now, some banks offer different lock periods. I've seen 105 days, certainly 120 days. During COVID, there were 180-day locks, 270-day locks, 365-day locks. I haven't seen too much of that recently, and you may not want to do that in the environment we're in, where, yes, we're filming this in September of 2025. Rates are good based on a 24-month average, but they're probably not going to be so good that you're going to want to tie that bank down for an extended period of time. Also, some of these extended lock periods, maybe 120 days and longer, depending on the bank, may come with additional fees to lock. Now, usually those fees are prohibited on VA loans, but on conventional loans, there could be an upfront cost to locking an interest rate. Some of those fees are non-refundable. Some of them can be credited back to you at closing. But the general thinking is the longer the lock period, the higher the interest rate. So what happens if you do a 30-day lock, but you end up not being able to close for 35 days? Maybe you're not working with me and that bank isn't closing on time and they need to extend the lock period. Maybe there's necessary seller repairs and the loan will just not close on time. Maybe the seller's closing things down. They may need more time to move out. Regardless of the scenario, if you're not closing within the 30 days allotted on a 30-day lock, for example, the lock will have to be extended. What exactly does this mean? So at the end of 30 days, that lock will expire and the bank technically will not be able to offer you that same interest rate, but they can extend the lock, right? You can add days onto that lock so that you can encompass the new extended closing period. But there is usually a fee to this. Extending that lock can be charged on a daily basis, and it's a function of the loan amount, and the days required in terms of the extension. Be careful with this. Some banks will only give you maybe 2 bites of the apple, meaning you can only do 2 lock extensions. Other banks require that these extensions be done sort of in bulk batches, right? So let's combine both of those. Maybe a bank only offers 7 and 15-day lock extensions, and maybe they only give you 2 times to extend the lock. If you do a 7-day lock upfront and you need to extend again, you only get one more chance to do it. So you need to be aware of the lock extension policy if you're getting close to the closing period and you're not really sure you're going to close on time. So what are the lock extension fees? Well, they're essentially akin to points, right? You're being charged money for a certain interest rate. Now, depending on who is responsible for the delay, if it's the bank, maybe they should pay for it, right? If it's the seller, maybe the seller should pay for it. If it's maybe on you, you didn't supply the right documents and now they have to re-underwrite the file, you're probably going to have to pay for it. Either way, you should be aware of the cost to doing so. And the lock time period is important for another reason. A lot of times I will speak with borrowers who want to lock before getting under contract. Now, some banks will offer specific programs for this, where you are locking an interest rate before you're under contract. Technically, if you're not under contract, you do not have a complete mortgage application because you do not have a selected property. So that right there should prevent a lock from happening. But like I said, some banks have special programs to allow you to lock a favorable interest rate before you have a fully executed contract. What's the risk in locking before you get under contract? Well, let's say you, on a Saturday, you're about to get under contract with a seller. And on the Friday, rates were really good and you wanted to lock that in. So you go ahead and do a 30-day lock. Now the seller comes back to you and says, well, we really like your offer. We just need you to accommodate us. We can't close for 60 days. We need some time to move out, to move into our new home that's being built. Well, you've already locked in for 30 days. So now you have a couple of options. You could extend the lock for another 30 days, which will be very expensive, or you can cancel the lock, wait to relock, and then you're kind of going to be at the mercy of the market at the time when you are permitted to relock an interest rate. So long story short, why should you avoid locking before you get under contract? Because you don't know for certain what that closing period is going to be. Maybe you need a longer time period, or maybe you're going to say, all right, I want to lock ahead of time for 60 days. I know that will be plenty. If you end up closing in 21 days, then you have unnecessarily locked at a higher interest rate than you could have got if you just went with a 30-day lock. Okay, so we just talked about canceling a lock, right? You can do this. It is possible to do this, and it happens for all kinds of reasons. It happens especially frequently on new construction. I'll touch on that in a minute. Generally speaking, if you cancel an interest rate, if you cancel a lock, there will be a minimum time period that you will have to wait before you can relock with that same investor on the same product. Now, if you're changing programs, changing products, there may be ways around this. But let's just say you're going to close in 30 days. Then a week from closing, the seller lets you know it's going to be another 30 days or 60 or 90 days. You say, okay, well, my current lock won't cover that, so I'm going to cancel the lock. You may have to wait 30 to 35 days before you can relock without penalty. So most banks would let you relock within the 30 or 35-day time period, but there will be a fee to do so. And you won't be locking at then market conditions. You'll be locking under what's called worst case scenario pricing, essentially the worst interest rate that you can get during that 35-day cancel period. So canceling an interest rate or canceling a lock on an interest rate, generally speaking, isn't a great scenario to be in, which is why you don't want to prematurely lock on when you in any kind of circumstance when you're not sure exactly when the closing will be. Okay, and the last thing to touch on with locking an interest rate is that locking an interest rate protects you from market fluctuations, right? It protects you from the scenario of a week later interest rates going up. Once you've locked an interest rate, that bank is telling you that they will honor that rate and they will give you a certain amount of money to borrow at that interest rate into perpetuity, right? Over the course of the life of the loan. So it's a good way to hedge against the possibility of rates increasing, right? Now, in this market, where I would say pricing has been pretty unstable for the last 2 years or so, I will generally recommend that my borrowers lock as soon as they get under contract unless we've just experienced a negative pricing adjustment. So what do I mean by that? Let's say we get under contract on a Saturday. The previous Friday, conventional mortgage rates were at 6.625%. On Monday morning, they open up at 6.875%. So they've increased by a full quarter. I may be skeptical about immediately relocking. I might want to be patient to see if we gain back any of those losses, if we can get a small improvement. Otherwise, in this market, I would say it's generally advantageous to lock right away and kind of get while the getting's good. So what does a rate lock not protect you against? A rate lock does not protect you against market drops, right? Improvements in rate. But most banks will offer something called a rate renegotiation. Most banks will also tell you that it's their unique product and no one else does it. That's not really true. Banks will do this out of necessity. So a rate renegotiation is that during that lock period, interest rates drop. Let's say they go from 6.625 to 6.125. The bank is going to give you a better interest rate as rates have improved. Why are they going to do this? Is it out of the kindness of their hearts? Not really. It's because they know you could probably take that loan somewhere else and relock with a different bank at that new lower interest rate. The only catch here is that most banks are going to require a significant improvement in rates in order to do this. Those banks get hit with a fee when they renegotiate the lock. Someone needs to pay that fee. The person who pays it will be you. So with a modest improvement, there's not enough margin to absorb that fee. But if there is a significant improvement, they can bake that into the new interest rate. You get a lower interest rate. The bank still protects their margins, and you don't have to pay an extra fee. Okay, so what is the opposite of locking? We call it floating. That means your interest rate is going up and down with how the market goes, right? Now, in some instances, floating may be a good idea. Like I just said, it could be a smart strategy if rates have just deteriorated after you got under contract. Oftentimes, when bad news happens, the market overcorrects, and in the following days, we'll see a small clawback. Maybe we're not going to get right back to where we were the previous Friday, right? But maybe we claw back an eighth, right? Or maybe you don't have to spend quite as much in points to achieve that same interest rate. Either way, there can be circumstances when it is a good idea to float. Another time it may be a good idea to float is if you have a long closing period, maybe 60 days. Depending on market conditions, there can be a big jump between a 30-day lock and a 60-day lock. In my experience, usually the difference between 30 and 45 days is modest, if at all, but the difference between 30 days and 60 days can be significant. It's not always the case. Sometimes the 60-day lock is the same as the 30-day lock, but sometimes the distance or the difference between the 30 and 60 is so great that you may not want to bite off that 60-day lock quite yet. You may want to wait until you're within 45 or 30 days of closing to get that better pricing and lock at that point. Another scenario where you would not want to lock right out of the gates is with new construction. If I had $1 for every one of my borrowers whose new construction home was not completed on time, well, I'd have some dollars, right? The moral of the story is when you get under contract with new construction, generally speaking, the contractor is not obligated to finish that home by a certain deadline. In other words, there are no consequences to them if they're not finishing on time. Right now, if you're not ready to close on time, you could pay for the delays. But on the builder side of the house, the way those contracts work, usually there aren't any penalties for them being late. So if they tell you a home's going to be ready in 6 months, should you do a 6-month lock on day one of being under contract? Probably not, right? Number one, you're not protecting yourself if the builder is late. Number two, if they are late, they're probably not going to pay for your lock extension, right? So you're going to have to pay for it on your own. So on new construction, if you do want to lock up front, you need to give yourself a lot of cushion on the back end to account for the scenario in which the builder is not done on time. How much time do you need to give yourself? Well, it probably depends on the construction period. If the construction period is going to take 1 year, you may want to give yourself 120 extra days, right? If that closing or the construction period is 6 months, maybe you only need to give yourself 60 days. But you do not want to lock early and have to face the scenario of canceling a lock and relocking or paying for costly lock extension fees, especially when those builders are, for the most part, not going to be very sympathetic to covering those fees, even though the delay is attributable to them. Again, my name is Steve Doherty. I'm the Raleigh VA loan guy. I'm licensed to do mortgages in North Carolina, South Carolina, and Virginia. If you would like me to talk to you about interest rates or get you pre-approved to purchase a home, I will leave my contact information in the video description and in a pinned comment below. Thank you so much for watching this video. Please don't hesitate to reach out with any questions, or if you'd like to engage in a dialogue, please leave a kind and friendly comment below.